Growing your business was hard, and you only sell it once. With a focus on marketing, communications, digital, and service businesses, the TobinLeff M&A advisory team is dedicated to helping owners maximize and monetize their life's work. Welcome to the TobinLeff M&A podcast.
Welcome. Hi, I'm David Tobin from TobinLeff M&A Advisory Group. I am pleased to be here with a fellow business owner, founder and CEO of Fiscal Advocate, Jon Morris. You're going to hear about Jon in a moment, but I love his journey. You're going to hear how he started, founded one of the most successful digital agencies, independent agencies at the time, one of the largest in the world, sold it, had a liquidity event to a PE-backed strategic, carried that forth to a vision to help owners grow their companies by making better financial decisions, to be able to leverage information to make those decisions, which leads to why I invited him onto our podcast on helping owners on that journey to eventually monetize their business. I'm excited, Jon, for you to share your journey in a moment, but just to that end, TobinLeff M&A Group, mission-driven to help owners maximize and monetize their life's work. That's why we're thrilled when we form a strategic alliance with someone like Jon, who can help our clients build value on that journey to monetize. So, Jon, welcome.
Great to be here, David. Thank you so much for having me here.
No, for sure. So, Jon, I touched on, you founded a company in 2004. I love the way you got the funding for that. You have to tell our audience how that came about.
Yeah, so I went to University of Chicago for business school, and they have an annual business plan competition called the New Venture Challenge. I actually had no interest in starting a company. I just wanted to win the competition. So I entered the competition. The original idea was to teach digital marketing to small businesses, and I won $10,000, and that became the seed money to start Rise Interactive.
So 2004, 16 years later, you sold it.
Yep.
You sold it. I love these stats. 300 people, 6 countries, you had offices. Why were you and your partners or members of your leadership team, why were you successful along the way?
So, there's a lot of things I think we did right. There's a lot of things we didn't do wrong. But ultimately, when you think about any business, all you have is time and money. And we have to make black and white decisions with gray information. And the outcome is black and white. Like, you as a CEO are either growing your business or you're not. And what we became great at was leveraging financial data to make better decisions to scale and grow our business. And so we made a lot of big bets and a lot of investments. And so those, I think, was really the drivers that I think helped scale and grow our company to the next level.
Love it, love it. So you sell that company, PE backed, you went through the M&A process, successful exit. I know you worked with the acquiring company for a period of time, and then you had an idea. You started your current venture, Fiscal Advocate. Why?
I stepped down on April 1st of 2020, right at the beginning of the pandemic. And by the way, I love April Fool's jokes. It's one of my favorite days. I did a ton of pranks on my employees, and I think it was payback. But finally, when you get this chance to, reap the rewards of all the 16 years of time and energy I put into it, the world was shut down. And I had 3 young daughters. And so I honestly started this company much sooner than I ever anticipated, but I had to do something with my time. In my last 3 years of running Rise, I had a business coach, and I would meet with the coach quarterly, and he would help us plan our initiatives for the next 90 days. And he kept on saying, the insights that you guys have is like nothing I've ever seen. He's like, you could start a business just selling these insights. And so it stuck with me. When you hear that, every 3 months for multiple years in a row, you start to think like maybe that is something that will be really valuable. But the other part is, I look at it as like service-based companies, marketing agencies, tech agencies, they're my people. And I really believe that I have a lot of wisdom to share based on what I did at Rise that can help other companies have similar or ideally even greater success than I had at Rise.
Well, I'm thankful you want to share some of your experiences and journeys. So, Fiscal Advocate, briefly just touch on the primary service offerings, and then I want to get into what you call your KPI pyramid, the your CPR score. But what are your primary offerings, just to set the
Yep.
stage?
So I have three core service offerings. So we offer bookkeeping. So it's like invoicing, AR, AP, payroll. We'll close the books for you. We then do something called FP&A, financial planning and analysis. This is kind of the core of those financial insights. And that is budgeting and forecasting, cash flow analysis, monthly insights, resource planning, all about you spending your time and your money more intelligently. And then the third service offering is strategic planning. And so if you're going to be gaining these insights, I want to make sure that you have the right ideal client profile, that you have a true differentiator, that you have a good sales and marketing strategy, that you know where you're taking your business.
Love it, love it. Now, what's interesting, John, what you just described might sound like an accounting firm,
Yeah.
a certain type of consulting firm, but then I'm aware because we've sent clients, but for example, you're putting on an in-person event called Growth Unlocked, what top firms do differently to scale faster. That sounds like a consulting firm, not a financial accounting management firm. So I can see you're bringing the two
Yeah.
approaches, two disciplines. That now we're going to come back to growth in a minute, but I love when you educated my partners and I on your group, you talked about your CPR score, and that really hit home in the work we're doing preparing companies for a sale. Touch on that, John, please.
So I was in a sales pitch about a year and a half ago. And the person said, I'm pretty sophisticated. I look at 315 KPIs every single day. In my opinion, if you're looking at 315 KPIs every single day, you're looking at nothing. And so I actually took the opposite approach. What's the least amount of KPIs you could look at to make decisions around your business? And what I realized is there are only three KPIs that matter. And every other KPI will roll up to one of those three. So the first one is how much cash you have relative to your monthly overhead. Microsoft bought LinkedIn for $26.2 billion in an all cash deal. And if you have lots of cash, you have lots of optionality as a whole method to scale your business. And so I put a lot of emphasis on cash. The second one is profit margin. In the service-based sector, you need to have a 20% profit margin to be at the best of the best. And I know every single dollar of what you should spend in every single area to help someone get to that 20% profit margin. And then the third one is year over year revenue growth. So when you take that cash, profit margin, and revenue growth, the first three letters are CPR, hence the CPR score. So we created a machine learning algorithm that can actually determine, kind of like a credit score for an individual, your score for how you're doing as a service-based company or as an agency overall. I want you to have a 60 or higher, which shows that you have the right amount of cash, the right profit margin, and the right year over year revenue growth.
To so reinforce what you and your team developed on our end when we're representing sellers, talking to
Yep.
prospective buyers, the two of the key value drivers that every buyer comes back to margins and growth.
Yep.
Margins and growth. And we can try to talk about vision, which is important, and other, culture, other value drivers. But if you don't have margins and growth, you're not going to achieve a good multiple on your exit. Buyers
Exactly.
can't fund it.
And if you think about, um, you know, I keep on talking about time and money and how you spend that time and money. Everyone who starts their own business, who wants to scale and create a big company, is looking to generate wealth for themselves. They are looking at some point to exit. And, if you spend 16 years of your life and you're not scaling and growing the business, then you're not achieving your margin goals and you're not achieving your growth goals, which means that you're not spending your time and your money as intelligently as you can. And so that's really what I'm trying to do, is help people get that dream exit that they're looking for, help them create the careers for their employees that take them to the next level, You know, and so those are really the only metrics that matter. Now, how you achieve it is not easy. You know, like if it was easy, then everyone would be having the exits that they dream of.
Sure. So certainly building up cash is a byproduct of running a profitable company and
Yep.
maintaining a good balance sheet. Give our listeners just a few quick examples. Agency owners, professional service firms, where are you usually seeing areas where you can enhance margins?
So the number one thing I see is improvement of gross margin. So first of all, I'm going to give a little bit of definitions here real quickly. First of all, the way I define revenue is what I call net revenue. So when you take all pass through away and you just focus on the revenue that you actually get to keep, that is your revenue. And then you just have to subtract what I call cost of service. That is all the payroll, freelancers, um, technology, client gives, any travel and entertainment, anything that relates to client work. And so when you subtract net revenue minus that cost of service, you get your gross margin. And it is the most important number. And I'll tell you, like 95% of the companies I talk to, and I'm talking about companies that range from $0 all the way up to $55 million. You know, like I have and most of them are between 10 and let's just say 25 million, do not know what their gross margin is. And it should be 50%. If you are below 40%, you are most likely losing money. If you're between 40 and 50%, you're choosing between making money or investing in your business. If you're between 50 and 60%, you can actually invest in your business and achieve that 20%. And if you're above 60%, you want to make sure that somebody's not getting screwed. You want to make sure that you're not burning out your employees, and you want to make sure that you're not under delivering for your customers. So that is the key metric that you need to know in order to get you to that 20% margin.
Well, that's helpful and insightful. Thank you. This may lead or carry on what you just were touching on. So you wrote a book
Yep.
called Decision Making Science for Agencies. Is that the title? I'd love the
Yep.
tagline. And the tagline is a positioning statement, quote, unlocking the formula for explosive growth and profits. I mean, it's kind of a loaded question, but what
Yeah.
inspired you to write the book?
You know what? I mean, it's ultimately all the things that I do for my customers, I'm giving them the formula. You know, the idea is whether they want to hire me or whether they want to try and do it themselves. I'm in the business of helping. And, you know, it talks about a lot of the things you need to do from a financial data management standpoint to spend, you know, your resources in the areas that's going to help you grow.
Love it. First chapter of the book, budgeting and forecasting. I mean, it sounds obvious, but I can tell you during the M&A process, even before due diligence, buyers always want to see the forecast. And because it's normally a process that could take some number of months,
Yeah.
every interested buyer wants to see, are you tracking against your forecast? We have to update numbers monthly. That's the first chapter in your book. Just touch on the importance as it relates to somebody leading up to an exit.
So I believe that one of the key reasons that deals fall through is because the seller's finances are not in good order. And what people need to understand is there's a major trust factor. When you are buying something and that person's finances are in disarray, you know, they become skeptical. Is it really worth the value? Is the revenue really what they say it is? On the opposite side, if you are completely buttoned up and you have a budget and you have a forecast and, you know, like, you know, the numbers in and out, there's high level of confidence in what you're buying. And I think that people do budgeting, they don't understand forecasting. So let me explain the difference. A budget, in my opinion, is before the year starts out, they put something on paper that this is what I want to achieve for the year. But the reality is the very next day that becomes completely obsolete. They lost a client, they won a client, they upsold a client, they lost an employee, they gave an employee raise, you know, all these things happen. And so the idea by having a forecasting process, you are looking at either the remainder of your fiscal year or even going 3 years out, you're keeping this up to date. in terms of your analysis and what you think you can achieve. And so it is absolutely crucial. And it's also your greatest expense management tool. So I'll give you an example. 2 real examples in the last week. I have something in our budgeting and forecasting called blue sky revenue. Blue sky revenue refers to revenue that you are going to win from new business, but you don't know who, you don't know where, you don't know when. And everybody should have a blue sky number. Like if you have a sales and marketing team, like they have to have a go-get in terms of what they're going to achieve. But what's really important is to look at that over the next 30 to 90 days. So when you look at July, it's 13, 14 days away from today. And you're trying to determine if you're going to hit July, you need to look at your pipeline and you need to look at your blue sky. And if your blue sky is $500,000 and you got nothing in your pipeline, I can tell you you're not going to hit July. And so when you are selling your company, I promise you your buyers are this sophisticated. They're going to be looking at this and they're going to want to know how realistic it is in terms of achieving the numbers that you set out to do. And so having a good process, having a good methodology to take cost out of the business when you're not going to achieve things, is a really important element.
It's helpful. It's interesting. So, Jon, let's spend 3 to 5 minutes. Your experience selling a company, mine selling an agency I owned as well.
Okay.
You're working with service firms. In fact, you've created, let me give a quick plug for you, a professional community, a virtual professional community. Now, you do bring them together in person. Just 30 seconds, tell the listeners about that community. And then we're going to brainstorm ideas to help owners who are thinking about an exit.
Yeah, so the professional service community is a free community. It is designed for only service-based companies, and you need to be 8 figures or greater or a client of Fiscal Advocates. And it has a private Slack channel. It has peer-to-peer groups that are facilitated by me. We provide in-person events, as you mentioned. I bring in notable speakers on a monthly basis, and I provide resources to help people have tools to help them grow. And, it's designed for it's focused on the concept of the CPR score and people sharing playbooks. And there are 3 types of playbooks. Playbooks you absolutely should do, playbooks you should not do, and playbooks that are worth testing. And so the idea is that if you want to increase your revenue growth, let's learn from each other on playbooks that are going to help you grow. And let's learn on playbooks that you should avoid. And let's learn on playbooks that you should test.
Well, it's a perfect segue into how we're going to close this event. So, playbooks, advice that you want to share with owners. What's great about managing your business for an exit, it typically enhances your value as you go. They're not mutually exclusive.
Yeah.
Because running a solid, profitable company means you're going to be positioned for a more lucrative exit payday. What advice would you give owners? They're anywhere from 12 months to 48 months out from thinking about monetizing.
So the first thing is, which that you should understand how you're valued. So you're generally valued off of your EBITDA, and there's some multiple, and you want that multiple to be as high as possible. Now, one of the ways that you get a high multiple is year-over-year revenue growth. It's probably the key driver to multiple expansion.
Yes.
So if you want multiple expansion, you need to invest in 2 things. The first thing is you have to invest in sales and marketing. You don't want to be the best kept secret. You want to be the best known brand. And so you have to invest heavily in your brand and in the marketing. In order to do that, you have to be able to fund it. So this goes back to my gross margin comment. If you have a 50% gross margin or higher, you have more money to put into sales and marketing than if you have a 40% gross margin. And so my first big thing is just understand how important that is. And you need to have a mindset that we are going to constantly improve it. When I left Rise at a 57% gross margin, that gross margin gave me a lot more money to invest in my business and the infrastructure. The second thing is you need to invest in innovation. So your number one sales goal is never lose a client due to performance.
Mm.
And you want to make sure that what you deliver is better than what you sell. And I want you to think about that as a journey. Okay. Like, you might not be where you want to be today, but if you keep on investing in innovation and keep on making your services better, and that becomes a incremental snowball that rolls down the hill that nobody else could compete with. And so those would be, like, I would say, a few of the drivers that I think are really important is figure out how to fund innovation, figure out how to fund sales and marketing, and you should do it by understanding where to spend all your dollars in all the other areas of your business.
Such sound advice. Jon, thank you. If some of our listeners or viewers want to reach you, how can they do that?
They can follow me on LinkedIn. I post content very regularly and frequently. They can email me at jon@fiscaladvocate.com. And you can also go to fiscaladvocate.com. We have a resource section where you can learn more about how to help grow your business there as well.
Jon, thanks very much. And viewers, listeners, thank you for joining us. TobinLeff has mentioned our mission, helping you monetize all the hard work that you've put into building your business. Myself and my 7 partners, we welcome conversations. If you just want to talk about your business, growth plans, the M&A market, please reach us at TobinLeff.com. Thanks, everyone. Jon, thank you.
Thank you, David. This is great.
Thanks for listening to the TobinLeff M&A podcast, produced by Main Impact with music by Holt Vaughn. For additional resources, case studies, or to contact a partner today, visit TobinLeff.com and be sure to subscribe or sign up for our emails to never miss an episode.